Today's sponsor is Fasken Martineau. A word about Fasken. Fasken is one of the world's leading international business law and litigation firms. It has more than 700 lawyers in Canada, UK, France, and South Africa. The practice includes every sector of business, industry, and government. They've been named top corporate deal maker by LegalExpert. They're consistently distinguished in the prestigious Chambers Global Guide to the World's Leading Lawyers, the International Financial Law Review's Guide to the World's Leading Financial Law Firms, and the International Who's Who of Business Lawyers. The session will be started by Craig Brown. Craig is our president of TIE. He's a partner and chairman of the firm's private equity group. He's an active member of several other practice groups, including securities and mergers and acquisitions, and he also leads.
So, thank you all for coming. And it's a beautiful, beautiful night, and you could all be out playing frisbee golf or something. So I really appreciate you being here, and I think it's a testament to your entrepreneurial interest that you are here on a weeknight, spending 3 hours learning some of these fundamental principles. And these fundamental principles are really important to get your hands and arms around and your heads around. But some of the guidance I'm going to give you tonight is really fact specific. So for your enterprise, your idea, whatever stage you're at, your situation will be unique, and you're going to need to talk to a guy or a woman like me that can give you a little guidance that's specific to your challenge, your opportunities. So these are guidelines. They're not an answer. They don't answer all the questions, but they'll hopefully give you a good framework to help make some good decisions in the early stage of your company. Now, I know we have some bona fide entrepreneurs here. I expect we have many people that wish to be entrepreneurs, and that's their calling, and maybe some people here that have started and been involved in early stage businesses. So just so I understand the audience, can I get a bit of understanding? Who here has started a business or is in the process of starting a business? Put up your hand. Okay. And who here wants to start a business? Okay. That's everybody's got their hand. Okay. So we're going to talk a little bit about some of the decisions that you have to make early on. When people start their first business, working out of their garage, out of their basement, and it's just the lonely entrepreneur, there is actually a name for that business. Now that business, let's say that's the Craig Brown business, and I'm out there, I've come up with I'm trying to build some funky new app, and I'm churning away on my computer, and I'm actually getting some clients, and guys are paying me a few bucks to roll this thing out. And I'm putting that money into my bank account, and I'm making promises that I have to fulfill to these new clients. I'm what they call a sole proprietor. There's no corporation wrapped around me. I don't have any partners. It's just me, the lonely entrepreneur. And you, the lonely entrepreneur, are also the taxpayer. So that income that you make, that income is your obligation to declare that income, and you file that income as your income with Revenue Canada, with the CRA. As you incur expenses in building that little business, whether you're buying software components, whether you're buying hardware, whether you're paying your friend rent for their garage, whatever that is, you can deduct that against the income you make. So it's just like filing your own personal tax return. The problem, well, we'll get into some of the problems around that, but that's a sole proprietorship. Then there's something that, as your business grows, you say, you know what, I've got a core competency in writing software for a great new app, but I really need a great guy or gal that's got really good sales skills. So I need a partner. So then you go and you grab a partner. That has very significant implications. It's not like two sole proprietorships. Now you've created something that is very unique in law called a partnership, and that's two or more people carrying on an activity with a view to profit. And so it's very broadly defined, but the really scary thing about that is if you, the third party, are doing a business with, let's say you and I are partners. When you go out there and make a promise, that is a promise, that is a deliverable that both you and I have a joint and several obligation to fulfill. And if you don't fulfill it, they'll look to me. And if that promise involves a payment and you skip town and go back to the UK, I have to pay that debt. So having a partnership has a very, very significant legal implication to it. As you grow, and now the nice thing about having a partner is, it's not just that she's great at sales and I'm great at writing code. It's that together, hopefully, the sum is greater than two. That we've got ideas that are collective, our network capital, the men and women that we know, the men and women that we can sell our idea to, the men and women that will go out and be our sales force, our champions, our mom and dads, all that stuff that will go out there and wave our flag. It's a lot bigger than having just two of us. It typically becomes some multiple of two. And then, of course, as you get bigger yet, and your obligations get bigger, and your income gets bigger, and your ambitions get bigger, typically that's when you roll, and my friend David Fox will explain rolling your business from a sole proprietorship or a partnership up into a corporation. You can do that without creating any sort of tax implications, because if you and I are a partnership and we're actually creating some goodwill around this business, our brand's getting recognition, there's value attributed to that brand. When we sell the business and we make it, if we were just to transfer to a corporation with a rollover, there would be a gain on that, which would be taxable, but there's great ways to avoid that by doing a tax-free rollover, and David will explain that, but that's very fundamental. Now, this is a very, very common entrepreneurial path. Sole proprietorship, partnership, which can be two or more people, and then evolving to a corporation because of the benefits that go with having a corporation. We're going to talk a little bit about those. So we talked about a sole proprietorship. It's simple. If you want to have a name other than Craig Brown as your business, I want to have Craig Brown Brilliant Apps Inc., or not Inc., but just Craig Brown Brilliant Apps. I can register that business name and I am good to go. And I can set up a bank account. I can set that bank account up as Craig Brown Brilliant Apps, or I can set up as Craig Brown. But the bottom line is that you have to be very careful about mapping your revenue to your business and everything else. You want to keep it in a separate bank account so that if you ever get audited, because you're going to make deductions against that income, you want to have separate bank accounts, separate ledgers. So you just want to keep your personal life and your business life, even when you're a sole proprietor, clearly divided. Now, as a sole proprietor, you are personally liable for all those obligations you make. So if you go into a contract as a sole proprietor and you promise to pay for something and you fail to deliver, they can go after your personal assets for that with no limit how far they can go. So this is very important, particularly if you're in a relationship and you have a spouse or a life partner. That partner's assets can be liable too. So you have to be very careful about being very responsible. Once you go out there and you start carrying on business, this is something entrepreneurs learn often the hard way. People will be taking you seriously out there in the world, and they will be looking for performance on your obligations, and they will come, and they have the ability legally to come after you for non-performance of those obligations. So the advantages are you can set it up really quick, super inexpensive, costs about $40 to file a trade name. There's almost no regulatory burdens. The startup costs can be deducted against your personal income, so you can be very creative about that, and David will give you some guidance on that. I'm not saying overly aggressive, but there are very creative ways to shelter a lot of that income so you pay very little tax. And the great thing is, it's your show. I mean, this is probably why everybody in this room is here, is because they don't want to work for the man. They don't want to work in a big organization. They want to have their own gig. They want to be independent. And it's incredibly rewarding when done successfully. And even when it's not done successfully, but it's done with great effort and great dedication, it's very rewarding, because as every entrepreneur that comes up here and every professional service provider like me that works with entrepreneurs learns, failing is okay. In fact, failing is encouraged, because if you're not failing, you're probably not trying. So failure is not a problem. So take great pride in being a sole proprietor. Now, the disadvantages, we've talked a little bit about it. Your own personal credit is on the hook. If you are out there as Craig Brown, Brilliant Apps, and I borrow money and I don't pay it back, or I have a credit card in my little business name and I don't pay my credit card, Visa gets mad at me and cuts it off, your personal credit rating is the one that gets jeopardized. So you cannot muck around with this. You have to take it very seriously. So you have unlimited liability, it affects your credit rating, you are the business, you're not separately divided. Then you go out and you get a partner. And partners are great. You know, I've got 300 of them, love them, all of them, almost. And they bring, it's brilliant having lots of partners, because you know, you can only be good at a few things in this life. You know, those brilliant among us here are maybe brilliant at many things, but typically we develop core competencies. We have personality traits that make us great at certain things and not great at other things. So you bring partners in to balance it out. It makes for a great business. It's great to have someone to share ideas with. It's great to have someone to commiserate with when your day goes down the tank and you lose a client, and you have a shoulder to cry on. It is great having a partner. Being a sole proprietor is a very lonely place. It's very exciting, it's very independent, but it can be lonely. So having partners is great. But as I said earlier, you have to be very cautious. So there's the definition that we talked about earlier. So it's very broad. Once you're doing that, suddenly there's a very important legal principle that overlays everything you do. And the scary thing is that to the world, if you're presenting yourself as a partnership, your partners can oblige you to those third parties without you knowing, because they have the ability to rely on your partner, that he has the ability to bind your collective will. So you and your partners have to have very good communications. You have to have very good processes for keeping track of what promises we've made, what deliverables do we have, what debts have we taken on. Communication transparency is absolutely critical to a good partnership. As it gets bigger, you need as you get more partners and as your business gets more complex, you obviously have to develop systems. And it's really important to develop very disciplined best practices early in the going, because if your bookkeeping gets off to a bad start, it's very hard to remediate it. If your customer relationship management is poor, you don't have a good system, that can cause you problems. So, you know, I think one thing I will underscore through this whole presentation is make the effort to develop an ethos in your business about just adherence to best practices. Although it will be more expensive sometimes, it will take longer to get stuff done sometimes, it will serve you incredibly well. And when Susan speaks at the end of the night about value drivers, when you sell your business and the buyer goes to lift the hood, to see how the business has been run, to look at your books, to look at your clients, to call your clients, are they punctual? Do they deliver on time? Do they deliver on budget? All those things, when they lift the hood and do all that due diligence, that is when they will get leverage on whether, hey, you know what, this is a really well-run business. It's worth the price they're asking, and if they see weaknesses, that's when they will start to grind you on price and value. So it will really serve you well in the long run. I just have trouble keeping these going at the same time here. Now, a couple of things that we touched on earlier. You have to be careful about hooking up with someone with a great idea, because even though you haven't intended to create a partnership, if you're always out there, Laurel and Hardy out there, selling an idea, you can be assumed to be a partnership too. So you have to be very clear. If you don't want a partnership relationship established or perceived by third parties, you should be clear about that. Okay, now you, as I mentioned, you have rights and obligations. There is a common law duty, and you can get sued if you breach it, that you will act in good faith with your partners. So you will act honestly, you will act ethically, you'll be transparent in your dealings, and you will have full communication. So you won't be out there incurring debts without your partners knowing. So it happens all the time. I mean, my litigation partners are run ragged over partnership and shareholder disputes because there was lousy communication, and people made promises the other ones didn't know about, and then the shit hits the fan, and everything goes ugly, and then we get called, and it's good for us, it's bad for the economy, it's bad for business. So good practices and good communication, like any partnership, whether it's with your boyfriend or your girlfriend or your husband or your wife. Communication seems to be the foundation, or bad communication is the foundation of all evils. So, be honest, be forthright, and take that home and tell your boyfriend and girlfriend that too. But it really is the bottom. It is it's a cornerstone to everything. Really good communication and transparency. So the partnerships are, again, really simple and inexpensive to set up. You can. We can set up a partnership, all of us here tonight, we can go and register it, and that will be it. We can have business cards, and we can all obligate each other, or obligate our collective will to a third party. So we'd have to have very good communications about what we're doing out there. So as you get more than one partner, it gets more complicated, which is sometimes why people get nervous and they create a corporation, because then that liability gets limited, and we'll talk about that in a minute. The benefits are obvious, we talked a bit about that. When you bring two people together, you have two or more people's assets. It enables you to get more credit for your business. You go to your bank, they're way happy to see two people guarantee a line of credit than they are one. So there's a lot of great advantages in having a partnership. But I think without a doubt, the richest advantages is that your collective intellectual capital is just much greater, and you can get a lot of great ideas can be cultivated and nurtured much more effectively when you have people to share your ideas with. The disadvantages are very flat hierarchy with partnerships. As I said, I've got a couple hundred partners, and when we want to do something big, so example, we recently merged with a 75 lawyer law firm in Johannesburg. Incredibly exciting. 100 of us got it immediately. Awesome idea. This is going to be accretive. It's going to make marketing to Asia way easier because everybody wants to invest in Africa. We've got the best resource stock exchange in the world. All the African companies that are in mining want to be there. We should definitely do this. The other half of the partners said, no, I've got a regional municipal practice. Don't see it being accredited. Don't like the risk. South Africa's a mess. They're shooting laborers. What the hell are we doing this for? So everybody's got one vote. So when you have a bunch of partners, it's not like you can have a benevolent dictator in a corporation and follow me, this is the way we're going to go. Partnerships are complicated because you have to reach consensus, and it's really tricky because if you have a partner who feels isolated and 4 out of 5 of you want to go left and the one guy doesn't want to go left, he will probably end up feeling very disenfranchised, he or she, and the partnership will unwind or they will leave. So decision making becomes complicated. Joint and several liability. This is the big bogey that I've talked about. Is that you go out and you make a commitment that I don't know about, you leave town, I'm stuck with it, and they can come after my assets. So you got to have a lot of faith in the credibility and ethics of your partners. And dissolution is pretty easy. It's just filing a government form. It's dead simple. Everything gets a little more complicated when you get more sophisticated. So you can go to something called a limited partnership, and that's what this probably isn't very relevant to entrepreneurs, but it's important to know what it is because you'll hear it out there and it might confuse you. A limited partnership, unlike a general partnership, which is what we just talked about, a limited partnership is a creature of statute. So to create one, you have to do a filing, and you have to have a general partner who runs it, and you can have more than one, and that's typically a company. And then you have all the limited partners, and they cannot be involved in the management of the partnership at all. If they do, they lose their limited liability. So when you invest as a limited partner, and they often a lot of real estate projects are built with limited partnerships. Limited partnerships are used for many things where you want to have passive investors and one person or one decision-making body running the business. All these passive investors are limited partners, which means that the losses, the gains, the income is passed through. The limited partnership is not a taxable entity in itself like a corporation is. Whether if there's income, it flows through to the partners or capital gains, and they preserve their tax status as that, and it flows down pro rata to the limited partners and the GP. And how everybody shares is determined in a partnership agreement. But the nice thing is also losses, which is why often people in a construction project they'll have a limited partnership at first, where there's losses in the early stages of the project. You can flow those through to the limited partners, and then they roll it up into a corporation when they're going to be profitable. So it's a common tool, but it's probably not that practical for limited partners, but I mean for entrepreneurs. But it is an interesting tool. Joint ventures, a lot like partnerships, except that they are, if you say you're a joint venture and you're very clear that you're not a partnership, then you cannot obligate each other to a third party. So they are a nuance to a partnership. They're very similar. Joint ventures are created by a contract. You have to lay out very, very clearly roles and obligations and limitations on activities very clearly in a joint venture agreement. And you have to be very clear in your language that this is not a partnership, and you have to represent that to the world, that you're not a partnership, you're a JV, because then they can only look to the actual person they're dealing with to fulfill any obligations that the JV makes. Okay, now let's get to corporations, because that's where everybody is going to be heading. So you've got your partnership, you want to roll it into a corporation. A corporation is a great thing because if you roll your business into a corporation, or you start it as a corporation and you put $100 and you capitalize with $100, the most that you're ever going to be exposed for personally is that $100. They can't go after you for all your assets like they can in a partnership or like they can as a sole proprietor. So most people early on want to go to a corporation as quickly as possible because they really want that benefit of limited liability, and I completely appreciate that. The only problem is, and most honest accountants will tell you, not to suggest that there are dishonest accountants, because I'm sure they don't exist, but most accountants will tell you, unless you're making about 100 grand in revenue, it's often not easy to justify the expense of a corporation, because a corporation is a separate legal entity. It's a separate taxpayer. It has to file a tax return. It has to have an accountant do statements. You have to have an accountant do, well, I mean, you can do it if you wish, but at your peril, file the corporate tax return. So there's all that. You have to have a separate bank account. You have to have, it's a separate creature. It's got all the powers of a natural person. In the old days, and in many jurisdictions still, a corporation could only do what its objects said. And objects were lawyers would toil away with quill pen and say, this company will be involved in ship making and will be used for transatlantic crossings of goods and services. Well, that's all that company can do. If it suddenly wanted to start building printing presses, it wouldn't be allowed to do that. It would have to amend its objects to do that. Now corporations in everywhere in every province in Canada and federal companies have all the powers of a natural person. So anything that any one of us could do legally in business, you can do as a corporation. And a corporation can enter into a contract. A corporation can sue. A corporation, as I said, has all the powers of a natural person. Now, what is a corporation? Really, it's three things. It's got owners at the bottom. Those are your shareholders. Those shareholders then appoint a board of directors, and the board of directors are responsible for the overall strategy and direction of the company, and they are responsible for hiring management, officers, directors. So there's directors, shareholders, and then you got the guys that make it happen every day, and those are your officers. Those are your presidents, your vice presidents, your secretaries, your bottle washers, all those guys. So there's shareholders, the directors who are appointed by the shareholders, and then the directors appoint the management team. The shareholders who own it, as I said, they're the ones that capitalize it. They put the money in to get it going. As the business gets going, as it creates retained earnings, those retained earnings get reinvested back into the business so it can grow. If you don't have sufficient return earnings to meet your growth demands, then you either have to go out and borrow money, or you have to raise more equity, which means you have to bring in more shareholders or go back to your old shareholders and ask them to put in more money. But if the corporation goes and blows up and is unprofitable and loses everything, those shareholders will never lose any more than what they put in or what they promised in writing to put in. So if a guy puts in $100 and gets 100 shares and then does a promissory note that says, I promise to pay $100, and you give him, that's full payment for shares, by the way, and gets those shares, and he's on the hook for the $100 that he promised to pay if things go ugly. So if you go into insolvency proceedings, he still has to pay that $100 that he promised. Great thing about a corporation, and this is often very important to third parties that you're dealing with, where if you're a sole proprietor and you get run over by a bus, the business is gone. If you get run over by a bus and you've got a corporation, the corporation lives on. Now, it only really lives on, I mean, it will live on legally, and it will live on in the eyes of the tax man, and it will live on in the eyes of the parties with whom you have contracts. But it's very important, if you are building a business and you go into a corporation, you need to have a succession plan. So if something does horrible happen to a key person, that you've got insurance to either buy their shares back from their estate, so they're not sitting with his or her crazy spouse, which is also keeps my litigation partners very busy, because that's what happens. I mean, if I buy shares, and I have a crazy wife, I don't have a crazy wife, but if my wife was crazy, God bless her, she's away this week, so it's okay, I can say these things. If I own this company, and I own all the shares, or half the shares, and you're my partner, you own the other shares, suddenly I die, Jennifer's now your partner, and she's nuts. And you go, okay, well, I can't deal with her, she doesn't know anything about the business, she's a train wreck, she wants to take out her half the money, doesn't want to invest back in the company, it's terrible. So, as we're going to see in a minute, when you have a corporation, you have to have a shareholders agreement, because that shareholders agreement will lay out all the rules by which you will run that business. And if I do get run over, the right thing to do is have a mechanism in place. The best way to do it is to have the corporation own insurance on my life, so the corporation has the money to buy the shares back from Jennifer, and it's contractually in there that Jennifer has to sell them. She can't sit back and be nasty. She has to sell them. The company buys them back, or the insurance proceeds can be assigned to the remaining shareholder, and they can buy them. So either buy them back and cancel them, because the corporation can't own shares in itself. So if he buys Jennifer shares back, if the company buys the shares back, they're typically canceled. And then the remaining shareholder will end up having obviously a bigger share, or all of the entire share of the company. But even though I died and I founded the company lives on. So, corporate governance. As I said, if you're going to go to a corporation, then suddenly it gets a bit more complicated and you have to have rules. So, in most jurisdictions in Canada, you have to have a president and you have to have a secretary. Not sure why that really is, but they require that. Now, it can be the same person, so you can have a one-person corporation. That's fine. But the directors are responsible for the supervision of management, and the officers, or that president and secretary, are responsible for running it day to day, and they are accountable to the board of directors. So the board can't just sort of sit back and be passive. They have to make sure that the officers that they put in place are actually discharging the obligations that they've been hired to perform. And then I guess the great thing is, as we said, shareholders have no liability beyond what they've invested. Now, directors and officers can have some liability, and this is directors can be liable for certain required remittances to the government. So, vacation pay, CPP, those remittances that a corporation must make to Revenue Canada on behalf of its employees. If they are not made, the government can sue the they can ask the corporation to pay it. If the corporation does not have the money to pay it, they can then go after the directors to pay it. So do not take the role of a director lightly. I mean, it's got a very grave and very important fiduciary responsibility, which we'll talk about in a moment. Very high duty as a director to serve the best interests of the corporation above all else, above the interests of a specific shareholder. So you might be nominated, someday when you're a hotshot, tech entrepreneur, and people go, wow, I think she's awesome, and I want her on my board because she has all this great company building experience, and you come on. Well, you know, you have that potential liability, but you have a very strict duty not to simply represent the interests of the shareholder that wanted you on the board. You have a duty to the corporation as a whole, and that shareholder will go, whoa, 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 you know, protect my interests. I don't want to go right, I want to go left. You go, you know what? I have to vote in what I truly believe in after my most thoughtful diligence on the decision making, that this is the right way to go. And if it isn't the way you want to go, then next year you can ask me, you cannot nominate me as a director, but I have to, you know, perform my duty. So taking on the role of a director is very, very serious business. Okay, fiduciary duties, that's just what we talked about. You know, high duty of care in the common law. And the courts are being quite rigorous about this. Now, when directors say, oh, you know, I didn't know that our officers were taking money and stealing and spending it on bad things, that doesn't matter. You have a duty to be informed. You have a duty to demand that you be informed by your senior officers. So I'll give you this little anecdote. I'm acting for a public mining company. Public mining company had a very, very experienced, talented chief financial officer that came out of one of the big accounting firms. The company did several years of what's called flow-through share offerings, and flow-through share offerings are very tax advantage to the investor. But when you sell these unique flow-through shares, if you're a company, you have an obligation to spend that money on exploration expenses within a certain period of time, typically by December 31st of the next year. So the board would occasionally say to the CFO, hey, you know, are we spending all that money we're obligated to spend? And he'd go, yeah, like, don't hassle me. Of course, you know, I'm a smart CFO out of a big fancy accounting firm. I got it covered. Well, we find out that in fact he didn't have it covered, and the company is now $2 million offside in a market when we can't raise any more money. We're an exploration company, and now we're facing insolvency. Now we're also considering, you know, whether we bring civil proceedings against that delinquent CFO who has now been terminated. But I tell you, who's really scared is those directors, because if the shareholders go, were you guys asleep at the switch? Weren't you demanding to see reports, to see expenses? You know, like, you couldn't just take, you know, this guy's word for it. So we don't know if that'll happen. I mean, there haven't been that many cases when they've hung directors, but you're seeing more and more of it in the United States. And what happens in the States is typically followed, and at least in the corporate and commercial litigation up here, is followed in Canada. So, you know, more and more people, like, you know, when you get to be an old horse like me, kind of go, hey, I'll retire, I'll be a professional director, get all the juicy fees. It's terrifying now. Like, I think that is like a plan B is off the table, because the liability around it is very, very significant. And it's, you know, you really have to take it as a professional obligation. You aren't just there on a fee grab. So, you know, I take that seriously. Okay, we talked a little bit about shareholders agreements. Corporations, when you have a corporation, you need to have a document that memorializes the way the company is going to be run from the perspective of the shareholders. So you want to know what the reporting obligations are going to be, what are the responsibilities of the corporation to the shareholders, and what are the responsibilities among the shareholders as a class, as a group. It's very important that you have what's called a unanimous shareholders agreement, and that means every shareholder is a party to it. You do not want a rogue shareholder who's not privy to the agreement, and the reason is, there are many reasons, but the main reason is this. You build a great company. You have an opportunity to have a liquidity event. You're going to go sell your company, and you've got company A out there wants to buy you. They got a great price. Everybody's on side. You don't have an ability, and you've got a clause in there which is going to be called a drag-along right. You see this down at the bottom of the slide. Drag-along right is often in there. It says, you know what? If 75% of us think it's a great idea, we're doing it. We're not going to have a couple people that are really greedy, you know, stop us from having this precious liquidity event. So if 75% of us want to do it, we're going to drag the other 25%, that's the name, drag along, drag the other 25% along. So 75% of us vote yes, we're going. You can't drag along the guy who didn't sign the agreement. So he can be a nightmare, and again, see it a lot where, oh, he's a great guy, he's my brother-in-law, he's cool, but he's out of town. No. Find him, you know, take a fact version, you know, get it scanned. Do not leave anybody outside. Everybody's got to be inside the tent. Absolutely critical. So Some of the things that you deal with in a shareholders agreement, this is just absolutely common stuff you got to have in it. And if you need it, if you're building a company and you want one, you know, I can charge you, you know, $5,000 to build one. But in our new seed program, we have an excellent template for one, which we will give you at about half that price, help you populate it, and you got to have it. Okay, you absolutely have to have it. You want to have procedural matters in there. How many directors are we going to have? Who gets to vote them? Does anybody have a right to control the board? So does any particular, so a founding shareholder will often say, I want, you know, I'm happy to have 5 directors, but I want to make sure I control the board. I want to have 3 nominees. So those mechanics have to be set out in there. Those are often fairly hotly contested. Covenants of the corporation. What's the corporation's obligation to you? Well, the corporation is going to promise to give you quarterly or semi-annual or annual reporting. What is that reporting? Is it just giving you the accounting statements, or is it giving sort of a management discussion about what the company's doing? Is it delivering a revised business plan every year? What's our marketing plan like? So whatever you as a shareholder think is really important to you, if you're going to put money into this, or if you're the founder, you know, you have to be thoughtful that the guys you're going to go out and ask money for are going to say, hey, this is the kind of stuff I want. I want to see really sophisticated reporting. I want to see it quarterly, and you're going to covenant to do that in the shareholders agreement. Restrictions on share purchases, transfers, and sales. So this is the big one. As your company gets rolling, you go out, you do your first round, your mom and dad have been, you bled them for all the cash you can get. Now you're going out to a little further. You're going out, you're getting people you don't know. They're getting legal counsel. They want to know what the deal is going into this thing. So let's see your shareholders agreement. Let's see your subscription agreement. The agreement where I say, I hereby subscribe for a certain number of shares. And they're going to fill that out because the company wants certain representations from them that they're a suitable investor to go in to your company, so that the company is not offside from a securities law perspective. And then the shareholders agreement is the one that the shareholder is going to want to see, because he's going to see what are the obligations that are owed to me by my fellow shareholders and by the company. The big one will be, we've got this great company, we've got a bunch of guys and money in it now, we're rocking along, but one of the guys wants to sell. He's being squeezed, his marriage is melted down, he needs cash, whatever it is, he wants to sell. Well, you may not want to have a shareholder, he may have a buyer, but you may not want that buyer to be your new, you know, to be a common shareholder, to be kind of one of your partners. So often you'll stick in something called a right of first refusal. So if I want to sell my shares, the company will say, okay, Craig wants to sell his shares, he's got 100 of them, you offer them pro rata to all the other shareholders. So everybody gets a crack to buy them. And typically what you'll have is that everybody gets a crack to buy them, and if they don't all get picked up, then those that did buy them get to buy the remainder, and you kind of do this sort of waterfall until they're all exhausted. And if they're not exhausted, then the company you can often have a right in there to have the company, if the company has sufficient capital, and the company can only buy shares to cancel them if it will pass the solvency test. So as long as its assets exceed its liabilities, or its it's got sufficient cash to meet its current liabilities, if you can pass those tests, then the company is allowed to buy shares for cancellation. So you might have all that before Craig is allowed to sell to the third party. So that's very important for controlling who you're in bed with, quite frankly, because you don't necessarily want a shareholder who is also a shareholder in a competitive business. So having that in there is very, very common. Piggybacks and drag-alongs. Piggyback is that if the majority shareholder wants to sell, and the majority shareholder is also the captain of the business, he's the guy that's got the presence in the industry, or he's the idea guy, or he's the face to the community, and all the values around him. If he's selling, the last thing I want to be done is stuck back here holding the company. So if he's selling, you might want to have piggyback rights, which means if I'm that guy and I'm selling, you can compel the buyer that you can only buy Brown shares if you also buy my shares. So that's called a piggyback right, and that's very important to have in there. So these are really common mechanisms that are put in place to protect really the culture of the company, and also to make sure that there is, I think culture is a really big thing, but also just to make sure that you're strategic in who, particularly early on, you want to have the right shareholders. You want to have the right shareholders. You don't necessarily just want cash. In a perfect world, you want strategic shareholders who bring you more than just passive capital. They bring you customers, they bring you strategic access to new markets. They maybe bring sister technologies that you can partner with, but they bring more than just cash. I mean, cash is great, cash is important, cash is how you fund buying stuff, building stuff, but there are a lot of softer assets that shareholders can bring. So, be very thoughtful about that. Now, back to life insurance, the last thing on this slide. Very, very important to have insurance on, ideally, you want to have it on, have insurance that will cover the life, it really covers the life of, if there's just a small group of you, you might want to have insurance on the lives of everybody, so there's enough dough there to buy them out. So again, you don't want the crazy husband problem or the crazy wife problem. So having money there to buy their shares back from their estate is very important. Also very important if you have a great colleague with you and he's a really important shareholder, and God forbid he or she gets a disabling disease or is in an accident and no longer can perform their function at the business. It's great to have long-term disability insurance for them, but it's great if you can get insurance where you can get some insurance where you can help buy them out. And it's really valuable to think about these worst-case scenarios early on in your relationship, because these horrible things do happen, and you can have a great business. Your business can be on a fabulous trajectory, and then some horrible event, completely unexpected, happens, takes out your partner or one of your key shareholders or one of your key, and typically at this stage, your shareholder is also your officer, is also one of your directors. So you lose one of your key parts of your team. You want to have some way to keep the business going without that being catastrophic for your business. So having insurance is really worth considering. Well, we talked about all this stuff, I think, pretty much. Yeah, preemptive rights, that's what I didn't talk about. We talked about the three at the bottom. Preemptive rights is just that you go around, you have you've got, the three initial shareholders, you've gone around your friends and family, you've exhausted them, but suddenly the thing's starting to rock. And the preemptive rights there is to protect the early supporters. So often, the early supporters will say, hey, you know what, if it is starting to rock, I want to have a first crack at, if you're going to go out and raise more capital, you got to come to me first. I have to have the right to preserve my position and not be diluted. So having preemptive rights in there is a very fair thing, and I think a very important thing to offer to your early supporting shareholders. So that is sort of an overview on sole proprietorship, partnership, and corporations. But I would be delighted to answer any questions you might have. Please don't be shy. Yes?
While I understand the benefits of the unanimous shareholder agreements, how practical is it to have these unanimous shareholder agreements in public companies where shares are being traded?
You can't. Public companies, you can't do it. It's only for private companies. Yeah, absolutely right.
So as you take on shareholders, the control becomes an issue. And what I have heard is that there could be different classes of shares.
Yep.
People can have a class of shares which would help them retain the control.
Yeah, you can do it. You can do it with separate classes of shares, and shares can have different voting rights. You can have non-voting shares. You can have super or multiple voting shares to give certain shareholders certain unique rights. More commonly, what you see is in a shareholders agreement, you will enumerate a number of things that require either the approval of a particular stakeholder or a certain threshold. So much more than a simple majority, which is typically all the board needs to move forward. You can carve out, and often there's many things. For example, common ones are, selling IP, taking on debt over a certain level, changing the strategic direction of the business. I mean, whatever you think is really core and fundamental to your business, you can articulate in the shareholders agreement that if we want to do one of those things, we take that authority away from the board of directors and it goes down to the shareholders. And then you have to have either the approval of that particular stakeholder or stakeholders, or you have to have you have to surpass a certain prescribed threshold. Say, and often these fundamental actions, as they're often termed, they require typically like 75% of the of the outstanding shares to vote in favor of them, which is considerably higher than your standard 51. So the one way to control it is by having an articulation of certain things where these are the very important strategic decisions that I want to have control over. So, I don't care if 99%, if Brown doesn't vote for it, it's not going forward. And often founders will stick that in there. And they'll often, and then it will often have a sunset. So if you reach a certain revenue level, then that right that's unique to that particular stakeholder may dissolve or be taken away or be extinguished. So you can put sunsets on these things, but having a clause in there that makes it very clear, what can be done by the board. The nice thing about a unanimous shareholders agreement, you can take back into the decision-making arms of the shareholders all of their powers or any portion of their powers. That's the beauty of a unanimous shareholders agreement, which you also cannot do if you don't have everybody in the tent. So again, underscore unanimous shareholder. It really isn't worth having one unless everybody's on board. So that's pretty key. Yes, sir.
You mentioned about preemptive rights.
Yes.
But one could have non-dilutive equity as well,
Yes.
right? So
Yeah.
then it doesn't come into question.
Yeah, very similar, same result, essentially.
Another thing I wanted to ask was regarding the insurance.
Yeah.
So when who buys the person out then? Is it the corporation or the other shareholder?
Yeah, so you can do it, and again, that's just left to the drafting of council. So typically, you'll have the corporation own the insurance. It can deduct the premiums. If there is a death of one of the insured, the proceeds go to the company, and then contractually, the company is obliged to use those proceeds to fund that acquisition. And they can, like I just did one recently where there's only 2 shareholders, but the corporation is going to own the insurance, but it's used to pay it on behalf of the surviving shareholder. The other option is to have the corporation buy the shares for cancellation, and then everybody's proportionate interest in the company goes. The proportionate share of the surviving shareholders is proportionally increased. So you can do it both ways. Sure.
You mentioned about the directors of the companies. They have, of course, way more liability than shareholders. The thing is, you also mentioned that the directors have to pay vacation pay and CPP.
No. So, want me to explain that a little better?
Yeah.
Where directors can have personal liability, and David can speak to this as well, the company has to make certain remittances to the government, such as certain so withholding tax, so if you have it on for your employees, vacation pay, things of that nature. If the company fails to make those remittances, the CRA will come back and ask the company to pay them. If the company doesn't have the ability to pay them, they can go after the directors to pay them.
Okay.
That's all.
Okay, and what about the, if you set up a numbered corporation and you tag a business name saying that you register in Ontario, you tag that, can you also tag other companies to that numbered corporation, sort of create an umbrella where each company has its own different services? Is that how it works?
I'm not sure I quite understand this first. So you create one corporation, you create one corporation, and then you want to have multiple business names?
Yeah, multiple companies basically. Can you put?
Well, you mean like really more like divisions, so they're not. See, well, it depends what you have to sort of weigh the pros and cons. So you can have one corporation, it can have multiple divisions,
Okay.
and they have clearly segregated activities, but all comes up all the income goes into one pot, and all the obligations are in one pot ultimately. Now, why you often have separate entities is to ring fence liability that might be unique to one enterprise and not to another, and you don't want to contaminate or expose one business to the potential liabilities of the other.
It's better to create a separate one.
It is, yeah. I mean, it costs about $1,500 to set up a company. Now, the ongoing costs are what kill you. Getting your tax return filed every year, filing you got to file with the Ontario. You got to keep a good status. You have to keep a minute book. You have to keep minutes. You have to file them. You have to do an annual filing. I mean, all that costs another $1,000 or $2,000 a year. So it's at least. I mean, if you actually have a fairly active business, and once you get a bunch of shareholders may want they may not want you just doing the statements on QuickBooks. They may want an independent accounting firm either reviewing statements or even doing audited statements as you get more sophisticated. And that's when the numbers really get big. So that's when having multiple companies can be fairly expensive. So you have to make sure that you've got the income to justify, or at least the expectation of income to justify that.
Okay, can you tell us a bit about the seed program that you're offering? Like, what does it entail?
Absolutely. No, we're very excited. As Lalit alluded to at the beginning of his opening comments, we have started a very innovative program here at Fastkins where we're trying to work with early stage companies have been typically terrified about coming to Bay Street law firms because of our fee structure, and totally get that. So what we're trying to do is where Bay Street law firms have not been interested in is that lawyers meet brilliant entrepreneurs and they tell them about this incredible new shiny thing they've designed and it's going to be a world beater, and lawyers go, it's the coolest thing ever. Of course, we'll get way ahead of your ability to pay for it. And we end up with a giant accounts receivable, and you go, oh, that shiny new thing, actually, I didn't realize there was a lot of other guys, the shiny thing is better, and I can't pay. And then our partners hate us, and so that was a bad model. So the new model is we need to apply lots of rigor and discipline around which of these early stage companies that maybe can't afford our rates are we going to take a bet on. And so take the lawyers out of the equation and hire a seasoned entrepreneur who's built many companies, sold many companies, and mentored dozens of companies to apply that discipline and rigor. And so now we will meet any young company that wants to talk to us. And we need to be convinced of the merits. We need to be convinced of the quality of the people. And we'll then do our own independent diligence on the addressable market that you're going after. And we'll look at your, is your shiny little thing, is it protectable? Is it protected? Is there a competitive shiny thing out there? All that stuff. If after all that we take a bet on you, then we will do creative fee arrangements. And we will do everything from just a modest discount on our rates to pretty much a free ride to a certain point. But there's no free lunches, So what we will do is our fees will be deferred, and when you are able to pay them, you'll pay a premium. Or we'll take a whack of stock at the get-go and warrants as we go along. So we're now with a limited number of companies, we're going to align our risks. So we'll take some risk, but if we're going to step behind you with the same risk profile, we want the same reward profile. So we want to have some skin in the game. We're going to have skin in the game, we want some of your stock. So we'll do that. So we have a great guy, Jeff Dennis, who's actually, he's an old hound, he's a classmate of mine, but he took the clarion call of venture capital, went out there, built probably 15 companies over his career, had some fabulous successes, had some spectacular disasters, learned a million lessons along the way, wrote a great book called Lessons from the Edge, which I would recommend. Maybe some of you, did any of you see Jeff speak here at the opening night? Anybody see him? Great guy. He is the guy, he's our gatekeeper now. So if you'd like to learn about the C program, we're developing a very robust suite of products, shareholders agreements, partnership agreements, subscription agreements, term sheets, acquisition agreements that are, they're absolutely first rate, they're fully annotated, which means that a younger lawyer can very comfortably take a young company, a young entrepreneur through that agreement very thoughtfully, understand not just the kind of deal specific stuff which he's going to get through an iterative process with you, but all the boilerplate that is often very important. He and she will understand it, understand the nuance, be able to walk you through it, but at a cost way less than it would cost to traditionally given, because typically you need a much more senior person to do that. So we're now able to push out these really critical early stage services at a much more our cost of delivery is lower, so we want to pass that saving on to you. So that's our ambition. And you know what? It's a little bit of a, I don't want to paint it too benevolently, but it took us a while to sell this to our management team because of that bad history. But we also recognize that the biggest problem that this country faces is that we do not have an innovation ethos. We don't have enough money supporting, we don't have government money, we don't have private money supporting early stage entrepreneurs. We don't have that highly juiced innovation community or ecosystem like you see in Southern California, that you see in Israel, that you see in parts of Northern Europe. We need to create that. And the government's finally getting its shit together, but it's slow to come. It's painful. This is our little effort to help. And we're really, we want to be the go-to law firm in the GTA for entrepreneurial firms, for early stage men and women like you. And which is why I got permission to give up 1/3 of my practice to help run TIE this year, because TIE needs to be bigger and better. TIE needs to build relationships with Mars. We need to see a concentrated delivery of services and support and capital to our young innovators, like the men and women in this room. So this is our little bit to give back. Yes, sir.
Rick, thank you for an insightful presentation. Just a follow-up question on the concept of the seed program. You mentioned something called looking at merits.
Yeah.
In terms of, from our side of the table, getting a sense of when we're ready to come and approach you with that kind of a request, what are kind of some of the more, what are those merits like that we should be focusing on?
Well, it'll be the quality of your business plan. You know, I mean, we want to see a sophisticated business plan. We want to see a unique product or service. We want to see an addressable market. And we want to see that you've got the men or women around you, or you are the man, that can drive that strategy forward. And we want to see how you're going to add the requisite talent around you, or bring the right assets around you as you reach that next threshold. So we just want to see you've been thoughtful, you've mapped it out, that you've put a lot of thought into it, and that you've got something unique and distinct. But you know what? You don't only get one crack. You can come in once and spend some time, and we might send you packing, but we'll hopefully send you packing with lots of constructive criticism that you can go back and reshape your idea. And we'll also point to there's a lot of great resources in the city. The problem is that they're not well coordinated yet. And that's another ambition of TIE, is that we want to be an agent for some coordination among all these resources. So we don't want to compete with Mars and the DMZ. We want to come together so that collectively we're giving really fabulous resources to men and women like you guys. Anybody else? Lay it on. Oh, more? Yeah, sure.
You mentioned shareholder loans required for corporations. How about limited partnerships?
Loans to limited partnerships?
The shareholder agreements, sorry.
Yeah, limited partnership, limited partnership agreements, absolutely got to have. In fact, you wouldn't really go into one without it, because, as I said, for a limited partnership to preserve their limited liability, they cannot be involved in the day-to-day management of the enterprise that the limited partnership owns. So you'll typically have very clear controls in there about what limited partners can't do and what the GP can do. Also, your limited partnership agreement is critical because that is the document where you memorialize how the limited partners and the general partner are going to share profits and losses. So you have to articulate that, because that's the only place you can't do it.
What are the key considerations you should be making when deciding to make the switch from partnership or sole proprietorship to a corporation?
Well, a lot of factors will influence that decision. So it might depend on the risk profile of your business. So if there's a lot of risk around it, a lot of financial risk around it, you may want to go to a corporation sooner, so you personally you mitigate your liability. So it's limited to the amount of money you put in or promise to put into your company. So risk management is a big thing. So risk analysis of your business. As you're bringing in, if you want to bring in people that are not going to be active in the business but are just going to be putting in money, then often it's better to have a corporation, because, again, as a partnership, you're exposing them to all the liabilities. They have joint and several liabilities, so they'll often be very nervous about funding you if they have unlimited liabilities. So once you go beyond your own personal resources or those of your family, then typically you want to go to a corporation.
Okay, so it's not just considering your revenues.
No, not at all. I mean, as I said, there are costs around creating a corporation and maintaining it that are not, I mean, there's several $1,000s a year, so you don't do it lightly. But once you've got a little run rate, it's probably a good idea to do it. But again, it's a separate legal entity. It's a unique taxpayer. It has to file a tax return, and you have to be very thoughtful in the way you do that, and you have responsibilities as a director. So your world becomes more complicated, but it also becomes, your risk profile gets altered too. So it's, you know, I don't recommend you do it too. As soon as you start looking for dough, I think you got to incorporate. That's really the bottom. I want you to go beyond your own bank. Yeah. So enjoy your dinner. Thank you. Over to the other way.